quantum of cash flow that the gold mining industry is going to deliver this year, I just don't think that the market kind of understands that. I mean, all-in costs are probably $2,100 an ounce. That's 30% free cash flow. Free cash.
David Finch, or Finchy, who is with us today, who we've been very keen to invite and explore a lot of topics with. Finchy, it's been a long time since we've spoken, but we loved kind of bringing you on to reveal your ways that you can actually save Canadian mining, which were a bit adverse to the rhetoric at the time. That was awesome, and I just think you from your position as a fund manager at Ixios there in Paris. I mean, you manage there's a gold fund, a copper fund, and also an energy metals fund. It's pretty much the whole spectrum of mining companies that you're across. And it's a pretty interesting time to be thinking about mining companies, particularly gold and precious companies right now, who are finding themselves with a lot more free cash flow than they probably thought was possible just 12 months ago. What do you make of the decisions that these companies are going to have to do with that cash?
Yeah, well, I think there is a big kind of decision point coming up. Gold mining companies have never had these kind of free cash flow yields. And I guess the question for most investors is do they switch into growth mode as they did in 2011, or do they kind of make a decent balance between reserve replacement and ensuring production beyond 2030 and cash return to shareholders? And I just think the fact that the sector remains, by any objective measures, very cheap, it is a result of investors' uncertainty about which path the industry and individual companies are going to go down in terms of dealing with this huge kind of wall of cash which is coming out of the gold mining industry at the moment. And I think there's reserve replacement, there's cash return to shareholders, and there's also the one that everybody's frightened of, which is the kind of push for growth in production. And I think until that's resolved, it's going to be difficult to see the industry re-rate. Stocks have gone up a lot, but they've gone up a lot because the gold price has gone up a lot. But we haven't actually had much or any multiple expansion. I don't think we'll get that until people are confident about what's going to happen with the cash and that it's a reasonably rational deployment.
The diversified majors faced this conundrum of capital allocation like a cycle ago, where they all emerged with these capital allocation frameworks, and there was a much greater emphasis on I suppose the dividends, the buybacks, and better managing of balance sheets throughout the cycle rather than getting too carried away in the good times. It's like the BHPs and the Rios of the world, they're by and large have made less bad decisions. I don't know about good decisions on capital allocation, but less stonkers in the last decade.
Yeah.
Do you think the gold sector is there, or they haven't had the reckoning where the amount of investor pressure to require the thorough capital allocation frameworks to roll across them?
I think the pressure is there, right? And certainly, when I meet larger gold companies, it's certainly, the first kind of item on the agenda. And to be honest, I think some of them are struggling with just pit, right? Because this kind of run into this very rich period of free cash flow generation has happened very quickly, right? It's not as if it's something that they planned for, and it's a result of the gold price going up an awful lot in a very short period of time. So I get the impression, talking to some managers, that they're addressing the problem, but it wasn't something that they had a plan in the drawer for a while, right? Because they weren't expecting it to happen. And I think for most gold mining companies who've been starved of any free cash for a decade, it's it's an extraordinary problem to have to be faced with, a nice problem to be faced with. It's just a question of how they kind of cut the thing between reinvestment and cash return. And I think that'll differentiate performance quite a bit over the next 2 or 3 years as to how companies address that.
And David, do you think that's that sort of fear of how capital will be allocated by these miners growing very impressive balance sheets and war chests is perhaps a fear or a reason perhaps why the generalists are holding back moving into the gold sector?
Absolutely. I think so. Yeah. I think so because, there's no denying it's cheap. There's no doubt that gold has gone up a lot and there's a ton of free cash flow there. I think that kind of lack of trust of management is what's really kind of held a lot of generalists back. I think perhaps not so much in Australia, where the institutional investors kind of the generalists know the sector very well, but in the US, for instance, where there's only one gold stock in the S&P, and then there's hardly any other precious metals quoted in the US. They don't know the sector very well, right? So they're not meeting the management of their gold companies in bars in downtown Perth every Friday afternoon, right? It's a much less closely knit kind of relationship between generalists and the mining industry in general, I think, in North America. So I think they, and of course, a lot of people are polluted by the memory of what happened in the last down cycle, where a lot of major supposedly blue chip gold mining stocks went down 90%.
Which management teams have just the exemplary kind of gold standard, excuse the pun, of capital management, good times and bad? Who should everyone replicate?
Look, I think there's different views about this. I think certainly Agnico's Eagle is often held up as a company that's had a good track record in terms of both technically in terms of building and operating mines, but also in terms of allocating capital to new projects in a reasonably contracyclical way, and have had a strong cash return policy through dividend increases and buybacks. I think that's kind of, I think everybody knows that, the market recognizes it. It's now got, I think it's now got the same market cap as Newmont, right? Everybody thinks it's Newmont, it's sort of giant, but so I think that's kind of recognized. I think that the question is more how the rest of the industry in general behaves. We can all find one or two well-managed gold miners, but you can't fill a whole portfolio with two stocks, right? So you've got to find other guys who have that potential, and who you can talk to and try and explain to them, what the market's expecting.
I've got an observation, having I listen to a lot of analyst calls, as I'm sure you do too, of a lot of mining companies, and of the gold companies, Agnico is still to this day, in my opinion, the only company that all the time just bangs on and bangs on and bangs on about per share metrics. Things have to be accretive per share. It's just like it's riddled through the culture of that company to add value on a per share basis. And no one else talks like that. Not a single other gold company that talks like that. So I don't think it's a coincidence that they are the gold standard. Yeah. Everyone else talks about a production target. Oh, we need to become a 400,000 ounce producer, a 1 million ounce producer. At what cost? Dilution?
Yeah, exactly. Yeah. Well, that's what we were saying before. Before the kind of talk started, is there is this kind of divergence, I think, between the views of people who buy gold mining stocks, who buy it as essentially as a leveraged exposure to the gold price plus a dividend yield, and the management of many gold companies who think that they have a mission to grow production, and that's kind of not what most investors want.
What do you want?
You don't want production to start going down, so you've got to replace reserves, you've got to plan for the future. But do you want to go from, do you want to make a very expensive acquisition to go from 500,000 ounces to 700,000 ounces? I don't think so. But particularly at this stage in the cycle. I mean, I don't know where we are in the cycle. I guess nobody knows at the time, but we're certainly not at the bottom of the cycle.
Yeah, do you think there's just too much of these mergers and acquisitions essentially just for growth's sake to, bump up the market cap to get into an index and get the passive flows and for those sort of, production growth reasons you were saying, David, rather than, perhaps these per share metrics we were talking about earlier?
Yeah. No, I mean, I think some of that does go on. That said, I also think in generalist terms that, we don't have enough large cap stocks that generalists can buy. There's only 4 or 5 really, which most generalists, running billions and billions of dollars can buy, and we have a long tail of often quite promising and well run kind of mid caps, which they don't even look at. Right? So I think it's I think those kind of mergers kind of need to take place, but it really is, as you say, on what combinations get shopped together. And we have seen in the past, we've seen some really irrational mergers where there's been no jurisdictional synergies, there've been no real cost savings, and it simply has been, as you say, to try and get into some index, and that usually doesn't end very well.
Dubious reasons for M&A. They'll always be around, I'm sure.
And of course you've got a whole cadre of highly paid bankers pushing them to do these things.
Yeah, incentives that vest on a change of control. All these things motivate an outcome.
So speaking of all these projects or expansions that are, becoming economic now thanks to the gold price, it's pretty important for these companies to take advantage of these, circumstances where they can and get those projects into production as soon as practical, whether, they're your core assets or your non-core assets. And this is where MMS come in.
It sounds like, Ali, you're defining, you've got this unique window in time where you can make money from projects that couldn't make money quite a long time ago. Well, you're not organised. You're going to need some help to get that thing to actually make money while the times are good.
Absolutely. So if you're going open pit, this is MMS's bread and butter. You only need to check out their track record at, Black Cat's Mire as an example. Are you open pit, currently open pit, but, maybe down the track you might want to do an underground extension. MMS make sure they look after the open pit ore body and treat it well. So then if a client does want to go ahead and do that and go underground, they are absolutely well positioned to execute on that.
They look after the resource. They're not just contractors that are doing a contract. They are looking after the resource for the future. It's all about the company, the relationship, the cash flow, the gold in the ground, getting it out. Non-core assets, if you haven't thought about them in a while, get in touch with MMS because their tech services team can do all the work to help you bring it into production ASAP.
MMS bring the technical depth you need, the production experience, and flexible commercial models to help you get there. Go MMS.
There's this a saying that everyone always comes across time and time again when you work in commodity industries. It's like you always want to be selling what China is buying, and right now China's buying lots of gold. Why are they, David, and for how long are they going to be doing this?
I think that I've talked about this before, and I don't think my views on it anymore are particularly original. But I do think that China tends to plan things over much longer time frames than anybody else, right? So because they don't have the problem of elections or midterm elections, or they're not planning towards a political outcome. They're planning towards some kind of national outcome, and they have the security to be able to plan over the very long term. So, I do think China wants its currency to become the world's reserve currency. I don't think that that's a plan that they've got for the next 2 years or 5 years. I think it's probably, a generational type plan. And you look at the growth in the Chinese economy versus the growth in the US economy. By some calculations, it's already the largest economy in the world. By some, it's number 2. And I think if they carry on going like they are going, and there's no reason to think that they shouldn't, I think it's going to end up being it's already the world's leading manufacturing economy by a long chalk. So I kind of think that they do want that exorbitant privilege of being the world's reserve currency. And I think the accumulation of gold is just part of a long-term plan to underline the credibility of that process. I think there's also, that there are many secondary and tertiary reasons which make it a sensible plan for them. And I think, that obviously, everybody's talked about this. I mean, the confiscation of Russian reserves invested in US Treasury bonds after the invasion of Ukraine, kind of, if anybody's next up for confiscation, it's got to be China, right? So, you've got to invest your reserves in something. And, I mean, they still own quite a big chunk of US treasuries, but I guess they're not going to add to those anytime soon. And, other than that, there's only really gold. The European government bonds held by Russia also got sanctioned. And, when you look at China's trade partners, I mean, the US portion has shrunk a lot, right? And the emerging market portion of it's grown a lot, which means that, they are receiving a ton of emerging market currencies, right? And I don't think they really want to own, have large proportions of their reserves invested in a kind of cocktail of Indonesian rupiah or Brazilian real. But there are just not many kind of asset classes or assets that they can actually invest in to replace bonds, right? So I think they're going to carry on buying gold, for a decade or two. I don't think this is a short-term thing.
It's a sombering thing to think through in terms of a potential market dynamics for a period of time. How are you positioning the portfolio right now? I mean, as a mining stock investor, you kind of always want to be a bit contrarian rather than pro-cyclical, but timing the cycle is everything.
And just to add to that as well, I'd love to revisit a tweet of yours, actually, David, which is probably quite applicable in today's market, being in a market where the marginal buyer is an idiot, it doesn't pay to be too smart. I'm wondering how much that applies still today when you're considering your portfolio allocation as well.
Yeah. I'm not sure that applies to the gold sector that much, because there's not very many marginal people involved.
Yeah,
mainly us gold managers shunting stock around between each other.
Oh, you should come to Australia. You'll find the marginal people.
Yeah.
We're everywhere.
Look, I kind of think that there's always this cycle in the gold equity market where at the bottom of the cycle everybody owns Agnico Eagle and Franco-Nevada and the kind of blue chip stuff, and as the gold price goes up, people get more and more daring, and there's a move towards buying. You end up with everybody loving the high cost, highly indebted companies, because they offer amazing leverage to the gold price. And then the cycle turns down and that all ends badly, right? And it can even be a relatively, it doesn't have to be the end of the upcycling gold. It can be just a correction, right? A 10% correction in the gold price. And then all these things that are highly leveraged kind of get into difficulty. So I think as a portfolio manager, it really is a question of balancing kind of the prudent allocation towards the good quality stocks and getting some leverage into the portfolio. And kind of rather than buy stocks that we see as unreliable operators with poor balance sheets, I'd rather try and get that leverage into the portfolio by moving further down cap and buying kind of quality explorers or quality developers rather than buying quality highly leveraged producers. So that's kind of what we've done. So I guess the portfolio has gone down cap a little bit over the past 6 months. I think the move into some of the kind of advanced explorers, stroke developers has kind of worked. In terms of increasing the exposure to explorers, as always with explorers, you get some that knock it out of the park, and you also get some who don't, right? So we certainly haven't seen a generalized move up in the exploration sector where everything that's exploring for gold has gone up regardless of the results. The market has actually been surprisingly, I think, kind of picky about which explorers it's allowed to participate in this gold price rally. So
yeah. The observation on the Australian market is like near term production is being rewarded massively. Advanced projects, marginal projects that are kind of option like, dynamics as the gold price rises, all of that stuff's getting rewarded. But the exploration, the neurology, all the really speculative stuff, the IPOs, none of that's here yet. I think so.
No, and it's been the same in Canada. There's whole swathes of guys, who've found stuff, right? But it's it's 8 to 10 years away from coming out of the ground, and because of the permitting thing, and it doesn't yet have critical mass in terms of the size of the resource not yet economic, and those things have also been left for dead in Canada. So.
What is the relative value between Australia and Canada right now? I mean, I noticed the portfolio is certainly dominated to the Canadian market versus Australia. Is that a function of relative value?
Well, no, I mean, I think we've got in the gold fund about 30% of the portfolio is Australia. I think the benchmark weighting in the GDX is probably 26, 27. So I think we're marginally overweight Australia. But I think I think what's good about Australia is particularly Western Australia is that you can get things done reasonably quickly. There's a lot of exploration, tenements on granted mine leases, and you can get stuff up and going in a relevant time frame. I think the thing in Canada is, often it takes a lot longer than that. You're talking a permitting process which is going to take 8 to 10 years. So and I think that affects relative valuations, and people say, the Australians are a bit more expensive than the Canadians, but there's a good reason for that. And people tend to forget the time value of money and the time value of investors' attention span, right? Because you can have a wonderful geological endowment, but if you're doing sort of 7,000 to 10,000 meters a year for 10 years before you can actually start getting any of this out of the ground, people are going to lose patience. There's going to be endless equity dilution, and in the end, you're not going to make any money. So, I think speed to production is a crucial factor.
Absolutely. And just sort of building on that as well, David, in this sort of rising and sort of seems to be, sustained high gold price environment, have your views or your approach changed into how you filter for good projects, if at all? I guess, what was assets that were, truckable now versus 12 months ago, very different. Underground extensions, which you would be a complete waste of time 12, 24 months ago, are now being sort of considered as, very real, expansions of options for assets. How do you see that?
Yeah, look, I think it's always the temptation, and it is, a high gold price does bring lots of projects, does make a lot of uneconomic projects economic very quickly, right? I think you've really got to look at that, I think, in terms of how quickly this project can happen. Because, I think the gold price will be higher in 5 years' time, but, I may well be wrong. So I think it's very difficult to base a whole investment thesis on where you think the gold price is going to. And where you had that example of that Gold Road underground, I can't remember what it was, 1.2 gram underground resource, right? That they were talking about.
Yeah.
Sure, maybe that just about washes its face at 3,300 gold, but at 2,500 gold, it probably doesn't, right? So gold could get back to 2,500 before it goes on and runs up, So I think got to be very careful, and I think with low grade resources, you've got to be confident that there's the scale to keep the costs low, and you've got to be confident that it can come out of the ground in some reasonable time frame where you've got some idea of where the gold price is going to be by the time they get it out.
One of the things I really enjoy about the commentary or comments you put out there, David, is you're not afraid to be a bit punchy, or obviously the Save Canadian Mining was an example of that, but I've seen you comment on two recent deals in the gold sector as well, with maybe a not so glowing kind of comment. First one, more local, was Northern Star's acquisition of De Grey. How do you reflect on that kind of 4 months later, 5 months later? Do you still kind of question the dilution to Northern Star shareholders for De Grey, or do you think it's like it's a sound piece of capital allocation?
We'll see. I mean, I think my comment was that Northern's, neither Evolution nor Northern Star actually have a culture of building mines, right? They've been financial constructs where they've bought and operated mines that have been built by other people, and so this is a step into a new skill set for Northern Star, and I think nobody doubts that they've got the money and the resources to buy in or hire in the expertise that they need to build that culture. But my only thought was, this is a complex project, right? And I think my comment was that, if you're going to have a first stab at building a mine, this probably wouldn't be the one you'd choose, right? You try and choose something a bit simpler. But, I mean, that's probably a very reductive comment, because there's not 100 simple projects out there that you could have bought instead of buying De Grey, which give you that scale and that kind of buy life. So
exactly.
My point was really just to underline that I think that just taking the kind of De Grey mine plan such as it is and plugging it into the Northern Star model is probably a bit simplistic, right? Because I think it's going to be a long and tough build, I think, with many risks along the way.
And Equinox caliber.
Yeah, I mean, I think the problem with that deal for me was not so much the logic of putting the two together, although there's bits of that that didn't make a lot of sense to me, but bits that did. The problem was just with the ratios, because it was really put together as a merger of equals, and well, in terms of where it was done at market, right? A merger, and I just think Equinox has a ton of problems. So it has a very heavily indebted balance sheet. It has one of its largest mines, which is currently shut down in Mexico because of a disagreement with the local residents association. It's got one of its mines in Brazil, which had a pit wall collapse last year. And Greenstone, which is its kind of there's Castle Mountain East, which is a mine in California, still not got its expansion permit, and then they've got Greenstone, which is the big open pit mine in Canada, which they're currently ramping up. Well, certainly the Q4 production results from that were a little bit disappointing and maybe indicative of the fact that the ramp up there is not going entirely according to plan. And I think so they brought a lot of problems to this merger. And Calibre, I think, who've got a very low cost, highly cash generative series of deposits in Nicaragua, and Valentine line in Canada, which is ramping up. Also, another large project ramping up, probably ramping up a bit better and a bit faster than Greenstone, thanks to the expertise of the team there. So I think both financially and operationally, Calibre brought some solutions to some of Equinox's many problems. And I think if you've got one side that brings the problems and another side that brings the solutions, you expect a premium.
Yes.
And there was no premium. Equinox have kind of, I think there was a pushback from a lot of shareholders, obviously not just myself, and Equinox have now agreed to pay a premium, 10% premium, probably still inadequate in my view, but I think enough to get it through the voting process that needs to happen on Calibre side. I think it was a wonderful deal for Equinox shareholders, not such a good deal for Calibre shareholders. And you kind of have to ask why the Calibre board agreed to this. I think there are probably many political elements within Canada. I think Ross Beattie, who's the major shareholder in Equinox, is a very influential figure in mining and banking circles in Canada. I'm sure he was very keen to get, I know he was very keen to get this project through. And then obviously on the Calibre side, all the change of control premium were triggered, right? So everybody who's involved in the Calibre management will have a very nice trip to the bank in a couple of months' time.
There was that con note that happened in conjunction as well. Like they obviously Equinox took some of the con note, but then there was there was
effectively a poison pill put in place to discourage anybody else from coming in for Calibre, and to discourage shareholders from voting against it. So I think that was a little sharp as well. So all in all, I don't think it's a deal that brought a huge amount of credit to the Canadian mining sector. I think it was a deal that did have some basis in operational and balance sheet synergies, that's for sure. I just think the way it was presented, the financial metrics of the deal initially were certainly inadequate.
Gotcha. When you're looking at the juniors in the sector at the moment, which ones are you getting excited about? Like where is the relative value? And feel free to list names of positions. We'd love to chinwag about them.
Yeah, I don't like to talk about individual positions much, but it's a smaller market, isn't it? But I think obviously you always get this with the bull market. There's a lot of old stuff that's being recycled, companies that have been relatively dormant for a decade, and suddenly the resource gets rediscovered and brought out and presented to investors, and there's a cap raise, and somebody has another crack at drilling it. I mean, there's a ton of that going around. I mean, there's 2 or 3 cap raises every day in Canada, and maybe 2 or 3 a week in Australia. So there's a lot of people trying to recycle projects, which have been kind of what we were talking about before, rescued by this rise in gold prices. It's a lot of work, I think, to dig into these and see whether, is this just, are we just trying to resuscitate the corpse, or can it actually come back to life, right? And I don't think there's any broad brush answer to that. You've got to look at everything. I think the other thing that happens is that people get braver about jurisdictions when the gold price goes up. Right. So, jurisdictions which have been, which people have been very suspicious of. The fact that, you can buy assets in poor jurisdictions very cheaply, and the gold price has gone up a lot. So the risk reward of trying to build a mine there, the reward side has gone up a lot. I think, it is going to mean that people are going to be looking at stuff in jurisdictions which had previously been on the kind of blacklist. So,
counterintuitively, the risk side kind of goes up too, because the more money you make in the risky jurisdictions, the more vulnerable you are to.
Well, the government's yeah, for sure. Yeah. Well, we've seen that a little bit already, but you tend not to get exploration projects nicked off you, right? They wait until you've built a mine before they either increase the royalty rate or expropriate it. So they're not really interested in buying a load of ground with holes in it. But so I think that people are going up the risk curve in terms of the juniors, because as everybody knows, in these countries, there's been less exploration historically. There's more stuff to find, and it's better grade, and So, to be honest, we've done a little bit of that as well. So,
to change tack a bit, David, you also manage the energy metals fund as part of Ixios. Obviously, noticing your copper position is your biggest exposure in that, and sort of a bit further down, lithium and tin. How are you seeing? Well, let's start with perhaps base metals and copper in particular. You sort of got a bit of sort of premiums or a divergence between the two exchanges sort of going on in the minute. What are your observations on copper at the minute, and what's sort of exciting you?
Yeah, look, it's always been a big part of the story, because the original premise of the fund was to do with the energy transition. I think that people misunderstand the energy transition. I don't actually believe that the energy transition was about saving the planet or reducing CO2 levels. I think that the energy transition is about a battle for energy independence, and that's why China's like a decade of everybody else, ahead of everybody else in the energy transition. They're not known for their kind of green credentials in China.
All this talk about the energy transition, Trav, has got me thinking about CBE.
Cross-boundary energy. Finch, he talks about the type of energy transition that people have got all wrong. I mean, CBE is all about the energy transition that Finch is really referring to, which is just coming from a place of energy independence. How do you have energy independence? Hybrid power systems.
Absolutely. I mean, these mines are going to get powered somehow. Why not consider the bloody legends at cross-boundary energy? Check out their website here. I love this. It literally says on there, why cross-boundary energy? Cleaner, cheaper power without CapEx or complications. I mean, what more could you bloody want than that?
Did you say no CapEx? No CapEx.
Yep.
I can get energy for no CapEx. That is a phenomenal proposition. It's kind of like getting something for free.
And we're talking, as you said, Trav, hybrid energy solutions for your mine. Whether that's solar, wind, battery energy storage, the whole kit and caboodle. Get in touch with the only name you need to know in energy solutions, other than cross-boundary energy, of course, Tim Taylor.
Tim Taylor. If cross-boundary energy is the solution that is good enough for Kamoa Kakula, Ali, guess what? It's good enough for your mine. And in fact, it's going to add value, tremendous value to your mine, just like Coca-Cola, the very impressive copper project. I am excited to see these popping up everywhere, Ali.
Go
Get
CBE.
in touch with Tim Taylor.
The principal strategic vulnerability of China has been their dependence on the outside world for energy, which is why they're now building God knows how many nuclear power stations and coating the whole of the north of the country with solar panels and everything. It's so that they can generate that energy within their country, and they're no longer dependent on, Australia for their coal and the Middle East and Russia for their oil and gas. So I think the energy, and people say, oh, well, all this green stuff is going out of fashion, so the energy transition's over. I kind of don't believe that. And I think that, the whole of the re-electrification of the Chinese economy is something which will come to Europe and to the United States, and it may be a decade away. But and all that is consuming vast quantities of copper, and I think that is the supplemental driver to demand. And we've seen this thing for a long time. In the copper industry is that more or less supply and demand balance out, right, with 1 or 2%, and then you get a major new factor. The last time we had a major new factor was the industrialization and urbanization of China, which pushed a step change in the copper price. I think that that's kind of happening now. Copper is like $4.65 or something. It's been up to $5.20. I think the market's starting to get the message. I think part of the problem for copper is that it's an incredibly noisy commodity because it's highly financialized. So, you saw that a couple of days ago. I don't know, you get some negative global GDP growth figures, or somebody revises their estimate down, and so all the hedge funds short copper. Right? So, there's an awful lot of short-term noise in the copper price. I think long term, again, this is not a very original observation, but copper is difficult to get out of the ground in large quantities. First of all, you've got to find a very large deposit, and then you've got to build it, and that's normally, well, in today's money, that's going to be tens of billions of dollars, and there's actually not many mining companies who have tens of millions of dollars to invest. So, I can just see a gradual acceleration in the rate of the growth of demand and supply not keeping up over the longer term. And again, I know kind of everybody's pretty bullish on copper, so I'm not very, it's not a very original observation, but some of these things you've got to hold on to your view through the noise, and I think there's some extraordinary kind of statistics that you can look at. So another sort of noise factor in copper, although it's died down a bit recently, has been Chinese real estate, right? And everybody thought that, well, everybody said that Chinese real estate is the principal driver of incremental demand for copper, and Chinese real estate's in the toilet, so it's all over for copper. But for the past 5 years, the Chinese national grid has bought about twice as much copper as the whole of the construction industry in China. And
Wow.
so, the drivers have just changed radically, but the inputs into the algos haven't, right? So when you get bad news on Chinese real estate, copper price still goes down. The Chinese must be loving this because, it's a wonderful opportunity to buy some more of what they absolutely need. So,
yeah, I've heard you mention in the past that commodities never discount future deficits until they happen.
No, and don't. No.
It's a funny thing to think about. It's a clearly obvious statement when you say it out loud, because we all know, things are priced, commodities are priced at the margin. Yeah, there's like these supply and demand inventories, yada yada. But it also does kind of just hit the part of you that learns finance, and if people expect a future, then surely that you discount that today. They're two weird conflicting thoughts to have about financial assets in some ways.
Yeah, and even if you think, like, copper's going to $7 by 2030, say, what are you going to do? Right? You're going to buy the futures and roll them over till 2030. It's going to cost you a fortune, right? Or are you going to buy, if you want to buy $100 million of copper, I mean, how much warehouse space is that? I mean, this stuff is only $10,000 a ton, right? And the cost of storing that for 5 years is going to be monstrous, right? It's going to wipe out your whole crop. So it's very, other than buying a company, right? Other than buying an equity, it's very difficult to play that kind of long-term vision through the physical commodity.
The optimal vehicle is the big undeveloped copper project where there's minimal dilution until the prices are much higher.
Yeah, copper in the ground.
Where's the best copper in the ground right now?
I guess I think there's some good stuff in Zambia. There's still some good stuff in the DRC. There's more stuff on the Argentinian side of the Andes for sure. Probably these are higher copper prices. There are some decent sized projects porphyry projects in British Columbia, but a lot of permitting uncertainty, I think, there. Just waiting on you Australian guys to find some more copper. Nothing less. Right?
Oh, I don't know if we can help you out too much on that front. It's slim pickings on our copper stocks, unfortunately. Yeah.
I was curious with your lithium exposure. Is that hard rock or brines or a bit of both? What's your view on the two, or perhaps in jurisdictions as well?
Look, it's a relatively small exposure for us, but it does seem to me that I think that the lithium industry has gone through this huge boom bust cycle, and I think that it's a relatively we've kind of stabilized a little bit now. I think to offset the kind of large kind of quantity of potential supply in the market, we've got this kind of sudden acceleration in battery storage. The Chinese have worked out how to make batteries, LFP storage batteries, in vast quantities very, very cheaply. But obviously they still need a lot of lithium for that. I kind of think the supply demand thing is balancing a little bit, but with the caveat that there's plenty more supply waiting to come on if demand starts to increase exponentially. And maybe we've got to the kind of balance that you have in the iron ore market, where actually we've found the right kind of equilibrium price, and we're going to trade around here for a long time. So I think that the thing is not so much hard rock or brine, it's just looking at projects and saying, how do they look, assuming the lithium price never goes up again.
Yeah.
Scary thought for a few lithium investors.
Is anybody going to allocate capital to them at these prices? Once they realize that we're stuck here at this price forever, and they abandon growth capex, and they work on reducing costs, and does this thing look a sensible investment? And that's kind of the criteria we've used for having a few lithium stocks in the portfolio.
You're a bit of a tin bull. I get the feeling, David.
Yeah.
I've observed when going through kind of some of the historic reporting of the Energy Transition Fund, like at some points AlphaMin was like your highest allocation of all stocks, and then at other points Metals X was certainly like a top 5-ish kind of position.
Yeah.
Never at the I didn't think ever at the same time, those two. You've clearly kind of been one of the few tin bulls to be active rotating between the two. Tell me about your thinking there.
Yeah, I mean, traditionally we've had very large positions in both stocks.
Yeah.
We've reduced. We've been reducing AlphaMin for a while now. We currently have no exposure. And we went into this big drawdown, when there was the big panic about what was happening in North Kivu without a position in the stock. The stock did go down a lot. We didn't add it back on weakness. And so, our big exposure now is Metals X, which I think is 7 or 8% of the fund at the moment. And my thinking about these two is that, I'm kind of here to play tin and kind of the economics of tin mining. I'm not really here to take a kind of geopolitical risk. I think with AlphaMin, it's clearly the better company. It's the better deposit. And, obviously the problem was always jurisdictional risk that crystallized with this incursion of M23 into the Eastern DRC. They've now signed a peace agreement or ceasefire. I'm not sure what it is. I'm kind of very skeptical about that, to be honest. I'm very skeptical about
that the US's ambitions will manifest in reality, or skeptical that the headlines will translate. Skeptical that peace will.
I'm skeptical the peace will.
Right.
I think M23 clearly their stated aim was to replace the government of the DRC, right? Which is why people got really nervous and why, stocks like Ivanhoe, which is, I think, 1,600 miles away from Beezy, right? Where AlphaMin's mine is, also suffered from this generalized DRC panic. And they were doing pretty well, right? With a kind of hearts and minds kind of thing, because the DRC army and their various associated militias have basically kind of terrorized the local populations in that area, ripped them off, and I think when M23 came in, they tried to put in some kind of decent governance and social protection and everything, and I think they were pretty much welcome actually as a better alternative to the DRC army or United Nations or South Africans or whatever.
That was a remarkable bit of footage when I think it was early February when the city of Goma was taken, and you could see this massive audience in the stadium. I think it was United Stadium or something. The stadium in the city, and people are singing and chanting. It was not what I thought in my head a rebel group taking a city would look like. It was these people were clearly welcomed by a large portion of the population. And the moment you saw that, it should have been should have been obvious to a lot of people that there was risk that it's not like you got rebels out here coming and taking. It's like, this is a movement of people, and the movement has appealed to people already in these areas too, for various ethnic reasons.
Yeah, and people talk about this agreement between the US and the DRC government. I mean, I haven't seen any terms of any agreement. I'm not sure what's in it for anybody, really. I didn't really see the US sending troops to the Eastern DRC. We shall see. But for me, the whole of the kind of the political toothpaste there is out of the tube, and I'm not sure it's going to get back in. So I think it's an amazing mine. I think it's a very well run company. There's nothing to say about that, and it's also incredibly cheap. But I think maybe the geopolitical risk has not come down as much as the market kind of thinks it has, but we shall see. Metals X, I mean, obviously it's an even cheaper company than, well, it's probably not now, but it was structurally a much cheaper company than AlphaMin. Obviously with kind of rather murky history of corporate governance, and an old mine that requires a lot of kind of love and care, but still, must be generating a ton of cash at this point of view, and with maybe the possibility of getting their hands on the other half of Renaissance. So, yeah, I'm happy to play tin through that for the moment, and certainly be very happy to go back into AlphaMen if we can get some kind of clarity. And I'm not sure M23 will be a bad thing for Congo, right? I'm not sure it's their plan to rape and pillage and steal all the mines, and that's probably not the case, right? This is a kind of civil war for control of the country, but it doesn't mean that they want to go in and destroy the assets and kill all the miners. But people are going to worry about that until the situation stabilizes.
Totally. Ding, ding, ding on Metals X, by the way. I should disclose I'm a shareholder. One of the parts of the portfolio that's changed over time within that fund is the uranium position. Are you? I know you took a fair few profits in uranium early 2024, which seems like very good timing. And what about now as uranium sentiment has waned? Are you getting more interested in adding uranium?
Yeah, we have put a bit of money in, actually.
Yeah.
Mostly in Australia, actually. So we bought some Boss a couple of months ago. That didn't look very clever when we first did it, but it's now looking a lot better. I did it, as I've often said, the problem has always been finding attractive valuations in the uranium sector. So because you've got all these uranium lunatics sort of, not selling their stock, you've got to, it's very, very difficult to justify the valuation on fundamentals without plugging in a much, much higher uranium price. And that's always been kind of my problem with the sector. We do own a bit now. It looks as if the spot price is showing some signs of life. I don't know if that's going to last or not, but it's clearly a hugely momentum-driven sector, and it really does need a much better uranium price to go up some more, right? I mean, nobody comes along and says, "Oh, we love this business. Let's buy that." We'll wait here for 5 years and see if the uranium thesis plays out. Well, I'm sure there are some people who do that, but the market as a whole, the balance is not that people do that. They kind of trade the sector with the momentum of the spot price. I think the spot price beginning to show some signs of life. Is it durable or not? I don't know. But I think, given how much the stocks have come down, that there are some stocks that just look modestly overvalued now rather than crazily overvalued. So yeah, we've added a little bit to the portfolio.
Isn't that funny? It's like uranium equities have maybe like trimmed minimum of like 50%. They're only modestly overvalued now.
It's modest.
Yeah. What's your most contrarian view at the moment, David?
What's my most contrarian view? I suppose still believing that the energy transition is going to happen is probably one of them. Most people seem to have thrown that out of the boat, but I think that's because they kind of misunderstand the energy transition. I think, most of the contrarian kind of views that we had have kind of happened now. And searching for some new ones. It's difficult. It's difficult. I think, there's two types of contrarian view, right? There's kind of the big picture one and there's the small picture one. And I think still everybody is bullish on copper, right? I mean, you don't find people very few people making the case for copper to go back to $3 a pound. But when you look at the stocks, the performance of the stocks, they are pricing,
Yeah,
but they priced a big change because it's come down a lot. Right?
they have. Yeah, but they would.
So they derated massively.
Yeah.
And they may have been over. I think they probably were overvalued at the top, and they've come down a lot. And I think they're now looking very decent value. They're pretty unloved, I think.
Yeah.
You look at things like Mac Copper or Capstone. I mean, they've just been crushed, right? And so I think they've lost their premium valuation. They've discounted a lower long-term copper price, and sentiment towards them is extremely poor. So I think that's a contrarian opportunity. I think the problem was, and myself included, is that we already held a lot of them, and people say, "Oh, buy on weakness," and you say, "Well, with what money?" Right? Because it's tricky, but I think that there's some good opportunities in the copper mining space for somebody who's still got the money and still got the courage. But the other, I mean, gold, obviously everybody's bullish, and I guess silver has been a disappointing performer relative to gold. I did an interview with another podcast back in January, I think, and the headline
shout out
it chose
Antonio.
was with Antonio, and the headline he chose for the thing on YouTube was "Silver is not my top pick for 2024."
Oh, he knows how to appeal to that North American audience.
everybody else loves it, right? But it has been a bit disappointing, and I didn't see that changing really a lot. I think maybe that's a contrarian view, is not being massively bullish on silver. I don't know. Everybody seems to be bullish on. But
I like your view on the copper stocks, and it is funny because even though the copper commodity price doesn't factor in a future supply deficit, like you said, but the equities certainly were trading on multiples that were suggesting the copper price is going to be much higher than it is today in the long term. And now that those stocks are not, what I found surprising is that there hasn't been a flurry of corporate activity. I'm like 12 months ago, every gold miner wanted to acquire copper projects, and now gold's the shiny new thing again instead of copper. All of this, where are those deals to buy the copper projects? Why is the floor price not the corporate activity? I find that interesting. I just think we've got short attention spans and all that sort of stuff. So gold is cool again.
Yeah. I think it's I don't know. Managements find it very difficult to be contrarian.
Yeah, that's true.
It's very difficult when everything is humming along and you want to buy something that's on its ass. It's very difficult. I know that management, just like investors have trouble being contrarian, so do managements, right? And then you put 10 people around a board table and try and get them all to be contrarian at the same time. It's kind of tough. Being a contrarian is a kind of individual sport, right? It's not a team sport, and by its nature, and
it's probably easier in private markets than public markets too.
Absolutely, yeah.
That's an interesting way to frame it.
Yeah. It's been a delight to explore some of this stuff with you, David. We should probably let you go, but if before we do, have you got any last kind of thoughts that you want to get out?
I just this is kind of a bit of a maybe everybody knows this already, right? But I just think that the quantum of cash flow that the gold mining industry is going to deliver this year, I just don't think that the market kind of understands that. I mean, all-in costs are, and I'm talking all-in costs, right? Not AISC or any of these nonsense metrics, right? But everything, right? Including growth capex, everything. Costs are probably $2,100 an ounce, and the gold price is $3,300. right? So that's a 30% free cash flow margin. Free cash flow. I mean, if you look at the period 2007 to 2024, the average free cash flow margin of the industry was 0.
Wow.
Right? So there were years when it was +2 or +3, years when it was -2, but the sum of it all is 0, right? So this is a really radical transformation in this industry, and how managements deal with it is a challenge, and some of them will mess it up and some of them won't, there aren't many industries that ever have a 30% free cash flow. So I think it is exceptional times, at a time when you certainly don't have exceptional valuations.
It's a super profit period of time.
It is a super profit, and of course people get nervous with super profits because they say this cannot last, right? So again, we need to start pricing the downturn, which the sector is doing for sure. But if you think that the accumulation of gold has got some structural drivers and that it's not going to revert to the mean, but gold has never reverted to the mean, really. Well, it has in 2 or 3 year periods, but like over the long term, it hasn't reverted. You can start to give this sector. Looking back, I mean, before, back in the 2000s, the industry regularly traded on 2 times NPV. We were in a structural bull market in gold, and people were pricing much higher cash flows for longer, plus reserve expansion, plus all kinds of things. Maybe that was a silly valuation, 2 times NPV. But today, I think if you put spot prices in the models, you're probably at 0.6.
Yeah, that's
Not even cracking the 1.
That's amazing to think about. Within the listed universe of like gold producers, or within the GDX, there is so much differentiation between performance. It's not like the rising tide necessarily lifts all boats. There's plenty of underperformers in there, which is a perfect environment for a stock picker who is familiar with analysing gold stuff. Yeah,
there's massive dispersion. There always has been in the GDX, right? In good years and bad years, there's always big dispersion of performance. Over 100% in terms of dispersion. But I just think in general, the industry, is really, people hate it. A lot of people won't even look at it. And when you get those kind of conditions, we know as people who are looking at it every day that, it's not the best industry in the world. In fact, it's not very good industry in general. But just when you look at the financial metrics, it does just look extraordinary, and the valuation hasn't really adjusted to that at all. I don't think.
What were the free cash flow margins back in that era where everything was being valued at like 2 times NAV?
Well, they weren't that good,
because
right?
the stocks were overvalued.
Yeah. You go back and you got free cash flow yields. Maybe the better ones got to 4 or 5. But yeah, so we really are in uncharted territory, and to be honest, even the really rubbish companies should be able to do very, very well. So,
you'd hope so, wouldn't you? Oh my goodness!
Buy some rubbish gold stock. Yeah.
Oh, what a fantastic note to wrap up on. Thank you so much, David, for your time and your insights today. Really appreciated.
Oh, it's a pleasure. Lovely to talk to you guys always. Look, really enjoy the show. Watch it every day when it comes out. So,
thank you very much.
I love it.
Well,
thank you.
Yeah, look forward to touching base with you sometime shortly, David. And good luck reaping the rewards of your gold stock allocation.
Lovely. Thanks very much, guys. You take care.
Thank you, mate.
Cheers.
Bye.
Yeah, bye.
What do you think of that, Ali?
That was awesome. No, I love Dave's insight, especially on the gold stuff as usual. But
you must be feeling happy to own a lot of gold stocks right now.
Yeah, I think it's just I think that sort of final point we finished on, or just that divergence between all-in costs and the gold price, and how big that free cash flow, yield and generation is relative to historical periods. I've probably never considered it that way. So that was really fascinating to walk through amongst everything else.
Well, we should thank our wonderful partners, Ali. To anyone going to the GRX conference, well, first of all, go. Second of all, use our discounts in the show notes. We've got to thank Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, KCI Site Services, Black Diamond Drilling Services, Cross Boundary Energy, and Hootaroo.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.